Today, we are digging deep into the financials of a true tech titan, Broadcom. We're going to go on a financial investigation to answer one really important question. Is this massive company actually getting stronger? Let's just start with a number that sets the scale here. $51.57 billion. That's Broadcom's projected revenue for fiscal year 2024. I mean, that's a figure that tells you just how deeply woven this company is into the global economy, powering pretty much everything from your smartphone to the giant data centers that run the cloud. So our goal here is to look past the headlines, and really understand the story these numbers are telling us. We're going to break down Broadcom's performance to see its strengths and, of course, its potential risks. And just a quick heads up, this is all for educational purposes. It is not financial advice. Okay, let's get into it. Here's our game plan. We'll start with where all the money comes from, and then we'll see how much of it they actually get to keep. After that, we'll take a look at their balance sheet, their ability to generate cash, and finally, we'll put it all together to reach a balanced final verdict. First up, let's talk about the revenue engine. See, to really get Broadcom today, you have to realize it's basically two giant companies stuffed into one trench coat. You've got the legacy chip company and a newly bought software powerhouse. And you can see that whole transformation playing out right here in their revenue. It's a story of just steady, consistent growth that suddenly, bam, goes vertical. That huge jump in 2024, that is the direct result of their single biggest bet yet, and we'll talk about that in just a second. All that growth is now split pretty evenly between two massive business segments. A little over half, 58%, still comes from their traditional semiconductor business, but a whopping 42% now comes from infrastructure software, a part of the business that, barely even existed a decade ago. So on the semiconductor side, we are talking about the absolute top-tier high-performance hardware. This is the stuff that forms the backbone of the internet, of data centers, of our wireless world. Think networking switches, custom chips for AI, the Wi-Fi in your phone. And then the software side is just as critical, providing the code that huge corporations depend on for virtualization, cybersecurity, and running their most complex operations. And this slide, well, this just lays out perfectly how that software empire was built. It wasn't grown from scratch. It was constructed through a series of, frankly, audacious, multi-billion-dollar acquisitions. It started with CA Technologies in 2018, then Symantec's enterprise unit, and it all culminated in that colossal $69 billion deal for VMware. So what's the big idea here? This wasn't just about getting bigger for the sake of it. The whole strategy is to diversify away from the boom and bust cycles of the chip industry and move into the stable, high-margin, predictable revenue that you get from enterprise software. It's all a quest for a more stable and profitable business. All right, let's move on to profitability. I mean, a giant revenue number looks great. But how much of that cash does Broadcom actually get to keep as profit? This is where we start to see the real muscle of the business. We're going to kick off our profitability check with something called gross margin. To put it simply, this just tells you how much profit Broadcom makes on its products right out of the gate, before any other business expenses. A high gross margin is a great sign of pricing power and efficient production. Now, this is where things get really, really interesting. Look at how dominant Broadcom is here. A gross margin of over 74%. That is just exceptional. It's way higher than NVIDIA and more than double what Intel is doing. It really speaks to the premium, best-in-class nature of their products, in both hardware and software. But as we move further down the income statement, the profit story gets a little more nuanced. So after you cover the basic costs of making their products, a lot of money still has to go out to pay for the company's day-to-day operations, and this is the key, the costs of those massive acquisitions. This includes things like interest on debt, which means the final, bottom line net income is smaller, but it reflects the price of their ambitious growth strategy. And those acquisition costs, well, they lead us directly to our next stop on this investigation, the balance sheet. This is where we get to see what Broadcom owns versus what it owes, and it's absolutely critical for understanding the risks that come with their growth by acquisition playbook. So the company now has this colossal asset base of over $165 billion. But, and it's a big but, to acquire those assets, especially VMware, it has taken on a significant pile of debt. This is the big financial trade-off right at the heart of the company's transformation. And of course, this leads us to the big question that every single analyst and investor has to ask themselves. Is this level of debt a major red flag? Is the company taking on too much risk? Well, the answer really comes down to understanding the strategy. This isn't just reckless borrowing. The debt is a calculated tool. It's a lever they're using to buy companies that they believe will generate more than enough cash in the future to not only pay down that debt, but also to fuel major growth. But it all hinges on one thing, cash flow. Exactly. A big debt load is only manageable if you're generating a ton of cash. So let's see how Broadcom does here. This is arguably the most important part of our whole financial investigation. First, a really quick definition: free cash flow. This is the purest way to measure a company's financial health. Forget about accounting profits for a second. This is the actual real cash the business generates that it can use for anything it wants. It really is the company's take-home pay.
And Broadcom has historically been an absolute free cash flow machine. This flood of cash gives management a very clear, consistent playbook. Priority number one is to aggressively pay down the debt from acquisitions. Then, what's left is used to reward shareholders with big dividends and stock buybacks, and, of course, to reinvest in R&D to stay on the cutting edge.
All right, so we've examined the core financial statements. Now, let's kind of zoom out and put Broadcom in context. How does the market value this company compared to some of its biggest rivals in the chip space? This table gives us a great snapshot. Let's look at the PE ratio, which basically tells us how much investors are willing to pay for each dollar of a company's earnings. Broadcom's PE of 36.5 is higher than peers like Qualcomm and Intel, but it's way lower than NVIDIA's sky-high valuation. This suggests the market sees Broadcom as a stable, high-quality business, but maybe with less explosive growth potential than the pure-play leader in AI. And then, once again, that gross margin just stands out from the crowd, reinforcing its best-in-class profitability. Looking forward, management has set a really clear target. They're projecting that $51 billion revenue figure we saw at the start, and they're banking on two key things to get there: fully integrating VMware to grow their software sales, and capitalizing on the AI boom, which requires the exact kind of high-speed networking chips that Broadcom specializes in. Okay, so we've looked at the revenue, the profits, the debt, and the cash flow. It is time to weigh all the evidence and get back to our original question. Is Broadcom's business getting stronger? The story the financials tell us is one of powerful strengths that are balanced by some very significant risks. The strengths are undeniable. You've got dominant market positions, world-class margins, massive cash flow, and now a much more diversified business. But the risks are just as clear. There's that huge debt load, the monumental task of integrating VMware, exposure to geopolitical tensions, and having a lot of your revenue come from just a few big customers. So to sum it all up, the financials really show a company that's in the middle of a truly audacious transformation. It is, without a doubt, becoming bigger, more diversified, and in many ways, more profitable. But it is also becoming more leveraged and a whole lot more complex. Which leaves us with the final question for you to think about. Has this aggressive acquisition strategy created an unbreakable financial fortress with a huge competitive moat, or has it built a giant that's just so big and complex that it risks becoming unmanageable? The numbers over the next few years are going to tell the story. Thanks for watching this deep dive into Broadcom's financials.